Isn't stock picking futile?
Oh, yeah, it's a good shot across the bow. I think you've teed us up well, kind of how you've structured conversation. And what I mean by that is like, hey, we've discussed factor investing. We didn't discuss to the same degree, but I'm happy to do so a little bit in more detail. One of the factors being momentum, the momentum effect, particularly around indices.
Are active ETFs the way of the future? My two guests say yes, but not in the way that you might think. I'm talking to Zach Wainwright and Greg Stoner, founder and lead portfolio manager, respectively, of Twin Oak, a company that makes custom bespoke ETFs for families that also are accessible for regular investors like you and me. These guys have worked for some of the best minds in the investing business, and I get to pick their minds today in this chat. So Zach and Greg, welcome.
Thank you, James. It's great to be here. Excited to share more about what we're building.
Before we do that, let me hit you guys with a little lightning round. This is very informal. No need to overthink or even think. Just quick reaction. First question from either of you guys on any question. S&P 500 in 1 year, higher or lower?
To the moon.
To the moon. I like it. EPS revisions as a factor. It's getting a lot of press. All that or overrated?
Makes perfect sense to me. I think it'll work for quite a bit until it won't.
Treasuries have dipped. Is it time to buy or not?
Yes.
Think about that one. Okay, got it. What's one thing, since I got two guys here, what's one thing you guys disagree on?
Hard to pick just one, James. I think really what makes Greg and I a great team is that we do actively push back on each other, and I think 1 + 1 is greater than 2. We disagree on things all day, and when I'm wrong, Greg will call me out on it, and when Greg's wrong, I just tell him he's wrong.
That's a feel-good answer. I was hoping we were some petty backbiting, but that sounds like a very noble answer. So, guys, thanks again for doing this. Can you each describe briefly your investing backgrounds, like how you came to this point?
Yeah, so I've wanted to be an investor since I was 12 years old for like absolutely no good reason. It was just a cool concept. Give someone $1, get $2 back. Like what 12-year-old doesn't like that? But I was able to kind of parlay that into learning from some of the greatest investment minds, of our generation, the prior generation, and have worked in my entire career in investing. Most recently, kind of managing a large single-family office investment pool. And my philosophy really just stems to three things. I think there's three different ways in which we can, as investors, put more money in our clients' pockets. Security selection, asset allocation, and structural value. And that's our job as portfolio managers. And we built Twin Oak really to focus around that third bucket is how do we create structural value for our clients?
Got it. And Greg?
Yeah, so I was a self-educated starter in college, investment clubs, reading books. From there, started managing a personal portfolio. My first two investments, although I did not hold them, so it's disappointing, was back in 2006-7 era. It was Apple and Nvidia. If I'd have just held, huge lesson in that, sold within a year. But I was bitten. I was bitten by the equity investing bug. So I was doing it on my own in the Army. At a certain point in the Army, I kind of felt like I'd plateaued there. So I stepped out to kind of pursue my passion in investing and started a career with long, short, typically market neutral hedge funds. So Adage and then eventually Scion Asset Management. My philosophy is really around its security selection. And it's, I like to select stocks and companies that have underutilized distribution competitive advantage. And then a management team that's announcing their intent to use that advantage and improve earnings. So that's why I'm a big fan of the earnings revision factor. That makes a ton of sense to me.
So Greg, I'll stay with you because it sounds like as portfolio manager, you're in the weeds on this stuff. It sounds like your root style is fairly traditional or fundamental, which is my style as well, by the way. What's something, though, the market gets wrong? This answer tells me a little bit about how you see investing.
Yeah, thank you. Yeah, that's a good one. So I typically tend towards the bias that markets tend to get things right in the long run. Mm-hmm. But in the short run, markets tend to overweight consensus views that may not be accurate, but they're acceptable. The kind of sound bites.
Yep.
And so the one I like to kind of point to right now is AI will greatly enhance productivity, which sure, but the next sentence, and this will reflect in near-term corporate earnings. And so, and my basic contention is that's probably not going to be the case. And there's probably some pretty good opportunities in the marketplace if you kind of roll with that thesis.
I love that answer. Economics and investing, which is a subset of economics. Economics is a social science, and we often forget that with all the quantitative stuff we have going around. I mean, it's still driven by humans. And if you're able to break free of those cognitive biases that derail most investors' returns, you can really score. So it sounds like you're on the track to do that. Let me segue now to factors, because you could argue that whenever we invest, we're investing based on factors. And I'm just defining a factor in the most broad way possible. Just some reason a stock could go up or down. It could be the CEO's haircut. That would be down in my case. It could be price to earnings. It could be return on equity. Those are the measurable, quantifiable factors tend to get a lot of the academic love just because they're, that which you can measure, you manage, right? What do you guys think about factors these days? Like, do we have too many, not enough? What are some of the hot factors? Are there any that are overrated?
Yeah, sure. Wow. There's a lot of ways you can go with that. And, there's such an academic arc around it. I think maybe it's helpful to discuss a little bit of Fama French, both the 1992 papers and then the follow-up in 2014. Very nerdy, very wonkish, so I apologize for the audience. So maybe the takeaways there is, look, there's a handful of factors that do seem to explain excess returns. One of them is small minus big. I think that makes a ton of sense. Basically, if you're a smaller company, you've got a smaller base, your growth rates are going to probably be much better than a much larger company in terms of both earnings and obviously stock price returns. So it makes a ton of sense to me. I tend to gravitate to factors like that, ones where the data kind of matches with a pretty good intuition. And so I think that's probably my view there. And that's, I haven't dug in deep to earnings revisions, but, again, like you mentioned at the top of the conversation, it makes a ton of sense to me intuitively. I don't know, Zach, is there anything you would want to touch on?
Yeah, I mean, look, I think to me, like my roots are as like a value investor. Like I learned from reading anything that Warren Buffett put out or Peter Lynch. And I think value is still probably one of the most dominant factors, but I think how value is defined has like massively evolved. Price does not equal value. That's kind of fundamental to what we think, or what I think as an investor. But I don't think value is just low price to book, how it used to be defined. I think value can be defined really different. And what is the intrinsic value of a business, and kind of what are the free options that you're getting when you buy into that, and that works for factors, et cetera.
Value is dead, and obviously it's not dead, but people say that. And the reason I'm asking is, yes, for the past 13 years, roughly speaking, 14 years, we've had this just resurgence of growth stocks at the expense of dividends, at the expense of value. And there is an argument, if you look at human history writ large, that goes back between 100,000 and 300,000 years, depending on how you define a human, that progress has been exponential, parabolic. There's been more progress made in fighting cancer in the past 10 years than in the past 100 years, as just one example. And so with connectivity of telephones, electricity, internet, now AI, things are moving faster and faster and faster and faster. So it's not the same era that Ben Graham, that Warren Buffett had their heyday in. And even those two eras were different. Buffett had to modify the Graham formula, right? And so now the Buffetts of the future have to modify the Buffett formula. Long story short, does value kind of get like down-regulated in this world, or is value just as strong as ever?
I mean, look, I think what's interesting is like Apple was a value stock in the last 10 years, right? All of these companies become value stocks at some point where the market is mispricing the future relative to today. And so value exists throughout cycles, even when growth is the dominant factor. I heard Seth Klarman say this once in a speech, that we make investing a lot harder than it needs to be. There's, we can all identify, like we could go around the table and say, what are the 10 greatest stocks that exist, like 10 greatest companies that exist in the planet? We'll say, some people will say Google, Apple, NVIDIA, Tesla. At some point in the last 10 years, 20 years, you could buy those companies for 50% less. And if you just bought them and held them, you outperformed every hedge fund manager and stock picker on the planet. and we make everything else we do makes it harder. Or just trying to justify just sitting around waiting for those moments. So like value exists, you just have to wait and take your turn. Nvidia was a value stock a couple years ago, right? Like the embedded future was baked. We just didn't know it. Some people knew it, and they made big bets on it.
At one point, Amazon used to be down 94% in the tech burst, and I think it rose like almost 60,000% after that, right? So it was absolutely a value stock from that same lens, you could argue.
Yeah, and when I worked at Scion, so when I was at Scion, we kind of the strategy there was actually paralleling Benjamin Graham and a little bit of the Berkshire partnership, and we had a ton of success. And one of the things I think that often gets missed when they do that juxtaposition of value and growth is that Ben Graham would be the first to tell you that he actually made more money on one stock than all of his other stocks combined, which was Geico. I believe it was Geico. and so I think within that framework, much to Zach's point, is like there's always an opportunity for value. It's just how are you thinking about the future? And hopefully, as the old value manager, the old value guard kind of has been washed out in the last 15 years, we start to get some we start to broaden how people think about value, which I think what Zach was touching on in a prior answer.
Hey, Greg, let me double click on what you just said about one stock driving returns. The more I know about investing, the more I think that's true in so many ways, both across stocks and across time dimensions. Across stocks, we look at Arizona State University professor Hank Bessembinder, I'm not sure the pronunciation. He looked at stocks, I want to say from 1926 until 2022, roughly until present, and found that just 4% of stocks drove all the returns in the US. The other 96% just matched treasuries. And I think 40% of companies lose money on an absolute basis, and 40% go to zero, 60% lose money. So it's a small number of stocks over the long run delivering all the goods. And it's the same thing on a time dimension. I remember from a JP Morgan study, something like over the past 20 years, it was like 1.9% of time periods in the S&P 500 drove 93% of the returns. Now, conversely, if you'd missed like the worst 1.9%, your returns would be or you would have returns 93% lower, I should say, to be more correct. And conversely, if you had missed the worst 1.9%, your returns would be like 2,150% higher. But either way, the principle still holds true. It seems like it's a small number of stocks across a small number of time periods that are actually driving real progress, up or down. With that in mind, isn't stock picking futile?
Oh, yeah, it's a good shot across the bow. But I think you've teed us up well, kind of how you've structured the conversation. And what I mean by that is hey, we've discussed factor investing. We didn't discuss to the same degree, but I'm happy to do so a little bit in more detail. One of the factors being momentum, the momentum effect, particularly around indices, with kind of the momentum that's kind of being generated by patent indices. Between those kind of two concepts and a little bit of the value growth debate, you can see there's some real benefits to actively managing things like weightings, concentrations, and kind of establishing some form of barbell approaches. So you've got some basic beta of an index, and maybe you overweight a little bit here based on things like value versus growth, small minus big, so on and so forth. And then maybe on the other side of the barbell, you think about maybe a shorting philosophy or a hedging philosophy. And so it really, to kind of bring it to kind of where I see Twin Oak and what we're trying to do is it's like, hey, how are you structuring this actively managed strategy? Are you structuring it in a way where you can kind of get this beta of the market and then maybe introduce some bells and whistles to generate much better through the cycle returns? That's I think this is where we see the value of active management. And kind of turn to yourself.
I would just add that I think, so much of those studies are like, what are the period that you started investing, right? If I created my portfolio as a static portfolio, in 1995, Tesla didn't exist, Apple didn't exist, Amazon or Apple existed, Amazon, hadn't gone public yet. So you would have missed out on so many of the biggest drivers of returns if you had just picked kind of a basket of individual securities, which is why we get back to diversification and having kind of a passive beta exposure in there is really valuable. And so owning the entire S&P 500, sure, you can outperform that potentially if you pick 10 stocks, but you could also massively underperform or miss. And then the other layer, which is kind of like leads to what we decided to build with Twin Oak, is when you introduce tax friction to that and making those changes from one security to the next, you can give up, a third or more of those gains, which both makes it so you don't rebalance or makes it so you're continually struggling to compound value at a long-term basis. And then you get back to Warren Buffett. What made it so great for him is that he could compound his portfolio for 50 plus years.
And so if I'm just a regular investor and I'm a little bit new to the technical stuff, by beta, you're meaning essentially buying the market as a piece. If you look at the market writ large in the U.S., it's been a pretty good measure of sort of capturing the value that American businesses add to society, which in general has gone up consistently, maybe something like 10% roughly per year for the past so many years. Like I sometimes use the example when I give talks that if you'd had a baby 70 years ago and put $500 in his or her account in the S&P 500 and not touched it, by the time that baby reaches 70, that's worth almost $500,000, which is just the power of U.S. stock. So that's step one. You want to build that as a baseline. Step two, you want to make it more tax efficient than the typical structure. Step three, you want to see how can we add alpha with some other actions, let's say. Let me just double click on the tax part, because that's something that sounds boring as heck when you mention taxes, but in a certain way, it feels like a much safer, more certain path to wealth, right? Because this alpha is going to ebb and flow, but the tax stuff is always there. Do I have that right? And just in layman's terms, how do you improve on tax?
Yeah, so I'd say this. So one factor and study that we kind of look at is like in the U.S., 95% of mutual fund managers will underperform equity mutual fund managers will underperform the S&P 500 over a 10-year period.
Yep.
Which is like eye-opening. Even though Greg and I obviously think we would outperform that.
You're in the top 5%, yeah.
But if you generate 2 points of alpha over that period of time, you're going to compound at such a massive value over a long period of time. But if you introduce taxes, you will actually underperform the market now, because of the friction of reinvesting and paying. If you have $100 and you sell it, you only get to reinvest $70 or whatever your incremental tax rate gives you. And so you're really just struggling to keep up. And so the real value is keeping your money invested for as long as you can and removing as many drags on that return as possible. And taxes, as you kind of pointed out, it's a known. If I do not sell my stock, I don't pay tax. I only pay the tax when I sell my security in the United States. And so, ETFs are kind of that on steroids, because ETFs kind of function in a lot of ways like a stock, even though they can create a basket of underlying individual positions. And inside of the ETF, they have the ability to rebalance kind of in a very frictionless way, which can allow you buy one ETF and you can allow that to compound for a long period of time.
Because it's a single security, basically, as opposed to, let's say, an SMA, a separately managed account, in which I would own a bunch of different stocks, pretending I'm making an S&P 500 allocation in an SMA. I would literally own roughly 500 stocks. It's not exactly 500 stocks in the S&P. It's a surprise, but it's sort of 500 stocks. And so that's what I own, versus if I just buy Vanguard ETF, it's just a lot simpler. But why is what you do better than Vanguard ETF?
Look, Vanguard was a pioneer of the industry, and they both set the stage for ETFs existing in the way that they do today, and bringing the entire cost structure down for the everyday investor. In my prior roles as an allocator, I'd sit there and say, "Look, great, I should have some S&P 500 exposure," and going to Vanguard and paying almost no fees is a great way to do that. But when you want to deviate away from that, there weren't really great options. If you wanted an S&P 500 with some bells on it, as kind of Greg said, it just didn't exist. And as you kind of move more towards strategies that Greg and I have run kind of in our hedge fund type days, those definitely did not exist in ETFs. And our whole concept is we can bring those strategies to bear, and the tools that Citadels and Millenniums, these big smartest guys in finance, are employing, we can bring those into ETF form on behalf of families and individuals, and do so in a tax efficient way in an ETF.
in that sequence, the family would presumably fund this if it's a family that has enough money. They get an ETF off the ground, this bespoke ETF, but at that point, it's not limited to a family. Anybody else could join in if they like the strategy.
Exactly. We work with families to develop the solution that they want that's kind of custom to them. But what works for them will likely work for thousands of other people. And so we use that family as a partner to kind of bring these strategies to market. But then we democratize access to everyone. And once an ETF is up, anyone can go buy it in their brokerage account.
Got it. And just to frame this for, again, the everyman watching, this type of investment would not be a substitute for going out and cherry picking NVIDIA as a speculative play. This is like a bread and butter cornerstone building block type thing of your portfolio, something that's sort of the market plus a little benefit, whether that's tax, whether that's alpha. This is something that I would kind of have a big chunk of my money in. And then on top of that, I might have this is the broccoli and the lean meat. And then I might have a little bit of candy and dessert on top. Is that framed right?
Exactly. I think you said it very well.
We can decide which one of you is broccoli and who's lean meat later. But okay, yeah. And so I guess my next question then, if you look at the ETF universe, it's really exploded with innovation, which is cool. I think we've got about 3,500, 3,600 ETFs in the US and maybe 4,500 stocks. So it's not quite passing, but it seems like it will at some point. You could argue, though, that the ETFs that have come out now have been kind of in two discrete camps, right? We got the buffered type thing, the very conservative zero downside type ETFs. Then we've got, as Eric Belchinus from Bloomberg says, the hot sauce stuff, the 3x 3x NVIDIA returns, which is really blurring the line between investing and gambling. You guys are you really on that spectrum in the first? I mean, obviously you'd be closer to the safe stuff in terms of it's almost like a Z-axis to that continuum. It's not really continuum. It's a three-dimensional thing. Is that roughly right?
Yeah, I think the way we like to look at it is that you can do, Zach in the beginning talked about those three buckets, and we've always seen it as instead of 1 + 1 + 1 = 3, it's like, hey, how do we structure this so 1 + 1 + 1 = 5? And so we can help, we intend to build stuff that's got the right asset allocation. We intend to build stuff that's got the bells and whistles or a little bit of alpha. And then we intend to build stuff that's structured well. And when we do all three, we've already got, some products that you should see soon, that you're going to see, wow, the total net return stream is significantly better than, its competition.
Yeah.
Sounds fun. Go ahead, Zach.
I would just add that, what we were talking about with, Warren Buffett, his brilliance is letting it compound for a long period of time. If you have to buy in and buy out, you lose so much of that power, and, you're then at risk for timing the market very poorly, as most people generally time the market very poorly. And so our whole idea is we want core strategies that you can hold forever. You should never hold a double levered Tesla fund or a triple levered micro strategy fund forever. You will lose all your money at some point. It will happen. And so therefore, that's not the game that we want to play. We want to create strategies that you can keep into your portfolio, into your kid's portfolio.
It's kind of like card counting in Las Vegas, right? If the card counter makes just even one mistake per hour, that messes up the whole thing, messes up the compounding, basically. And so let me just press you guys on some numbers. And I know these are speculative, but what you're saying sounds good enough, right? I mean, who wouldn't want a better than average S&P fund, right? But if we just pretend, for illustration, the S&P does 10% a year, what sort of additional benefit are we getting from the tax piece and then from the alpha piece, just in a generic strategy that you guys are envisioning?
It's funny because, I remember when the S&P 500, the long run assumption that you used to have was 7.5. It was like the base case, and now it's done so well the last 15 plus years that we've upped that to 10 plus. A lot of studies show that not making distributions from equity oriented funds adds about 2% per year, and that's studies by BlackRock and Vanguard of tax alpha. And again, 2% alpha per year, compounds over a 50-year period at a remarkable rate. And so that's really if we can capture somewhere close to that with our systematic strategies, then that's
locked in. I mean, that's not speculative alpha. That's kind of there for the taking, right? Just not making distributions.
Exactly.
Yeah, so, I mean, there's Twin Oak, and then there's like my philosophy right before I'm even willing to like entertain a strategy. If we can't do 200 to 400 basis points, or 2 to 4% of outperformance year in, year out, I'm just not interested. So that's like in my mind, like that's the goal. And then the reason for that is Zach touched on 2% over 40 years, depending on your assumptions, doubles your money. And those assumptions are very, vanilla, doubles your money, just that 2% outperformance. And so again, it's definitely a multi-generational, keep it compounding type of philosophy.
For broccoli and lean meats, 200 to 400 basis points per year is pretty high. I mean, that's amazing if you can do that. I'll be very impressed.
That's the goal.
yeah, gotta have a goal. So if somebody is watching this and says, all right, this is cool, I like factors that make sense, and these ETFs are interesting as well, and they'd like to learn more about Twin Oak or about you guys, where would you send them?
Yeah, go to our website, twinoak.com, reach out to Greg or I on LinkedIn. We'd love to have a conversation and share more about what we're building.
Sounds great. We'll put a link on the screen. Who came up with the name Twin Oak? Just curious.
So that was, I did. My, when I was thinking about kind of what to name our firm, I thought of like, my grandparents and great-grandparents that came before me and kind of the things that they had done to put me in the position to be launching my own investment firm. And my great-grandfather had a farm in rural Illinois, and it was called Twin Oak Farms. And so, I like the homage to him and kind of the lessons I learned from stories of him.
Yeah, it's the story behind the art that sells, right? Or the story behind the name in this case. So, Greg and Zach, thank you so much. You've been very generous with your time and with your expertise. Hopefully people will check out Twin Oak, and I will certainly as well keep an eye on you guys. Sounds like you're trying to bring good stuff to the market. Thanks again. And thanks to you guys, as always, for watching us at home.